Welcome. In today's explainer, we are going to tackle something that can feel, well, pretty overwhelming: the world of crypto and DeFi taxes. We're going to break it all down into clear, actionable insights, especially for you investors out there in California.
So, you're a crypto investor in California. Maybe you've been in the game for a while, and now you're diving headfirst into DeFi. Awesome. But then that little voice in your head starts whispering, what about the taxes? It can feel like a total nightmare, right? Well, the good news is you are absolutely in the right place. We are going to turn all that uncertainty into a crystal clear plan.
All right, here's how we're going to do it. We'll start with the big picture: why crypto is seen as property, not currency. Then we'll cover your taxable moves, decode the tricky world of DeFi taxes, get into some smarter tax strategies, and wrap it all up with a specific California tax plan just for you.
Okay, let's dive right in with Section 1. This is the big one, the single most important concept you have to grasp, because honestly, everything else we talk about today flows from this one idea.
So here it is, straight from the horse's mouth, the IRS. Back in Notice 2014-21, they made a decision that changed everything. They said, for tax purposes, your crypto isn't money. It's not like the dollars in your bank account. Nope. They see your Bitcoin, your Ethereum, all of it, as property. Think of it like a stock or a piece of art or real estate. And that single decision, it is the absolute key to understanding every single one of your tax obligations.
And this is why that distinction matters so much. Currency, like a US dollar, is, well, it's just a dollar. You spend it, nothing happens tax-wise. But property, that's different. It goes up and down in value. So because your crypto is property, every time you sell it or trade it or even use it to buy a coffee, you're not just spending it. In the eyes of the IRS, you're disposing of property. And that action, that disposal, almost always creates a taxable event. You have to track what you paid for it, your cost basis, and calculate a gain or a loss.
Okay, on to Section 2. Let's get practical and see how this crypto is property rule actually plays out with the moves you're probably already making every day. Seriously, just knowing when you're creating a tax event and when you're not is half the battle.
So when do you actually owe taxes? Well, pretty much any time you get rid of your crypto. Selling it for good old US dollars, that's a taxable event. Trading your Bitcoin for some Ethereum or even for a stable coin like USDC, yep, that's a taxable event too. Using it to buy a cup of coffee or a new laptop? You bet. And here's one people forget: earning it. Whether it's from staking, getting an airdrop, or getting paid for a job, that's all income you have to report. All right, now for the good news, the things that don't trigger a tax bill, at least not yet. Just buying crypto with dollars on Coinbase? Not taxable. Hodling for dear life? Not taxable. And this is a big one for our investor in Mountain View. Moving your ETH from an exchange like Coinbase over to your own personal hardware wallet. That is not a taxable event. Why? Because you're not getting rid of it. You're just moving your property from one pocket to another. It's still yours.
Okay, Section 3. Buckle up, because this is where we go into the deep end of the pool: decentralized finance. Staking, liquidity pools, wrapping tokens. I know, it can get really confusing really fast. But here's the thing: even in this Wild West, the same core principles we just talked about still apply.
Let's start with staking. When you're earning those sweet, sweet staking rewards, the IRS looks at that as income, just like getting a paycheck. The critical moment for taxes is when you gain what they call dominion and control. That's just a fancy way of saying when you can actually access and use those new tokens. The fair market value of those rewards on that exact day, that's what you report as ordinary income.
Now, providing liquidity. This one trips a lot of people up because it's a multi-step process with multiple tax hits. Check this out. Step 1, you take your ETH and USDC and deposit them into a pool. The IRS sees that as you disposing of those two assets in exchange for something new. Boom, that's taxable event number 1. Then, when you decide to pull your funds out, you're trading in your LP token to get your original assets back. That's you disposing of the LP token. Boom, taxable event number 2, you get taxed going in and coming out.
And then we have the gray areas. And wrapping tokens is a big one. You know, turning ETH into WETH so you can use it in DeFi protocols. The IRS hasn't given us clear rules on this, so you've got two schools of thought. The conservative, play-it-safe approach is to treat it like any other crypto-to-crypto trade, a taxable event. The more aggressive take is that it's just a technical change, not a trade, so it's not taxable. The bottom line? The safe route lowers your audit risk. The aggressive route? Well, It's a gamble until the IRS says otherwise. All right, Section 4. We've covered the rules, the good, the bad, and the ugly. Now for the fun part, how to use those rules to your advantage. This is where you can be smart and strategic to actually optimize your tax situation and turn all this knowledge into real savings.
Okay, this right here might be the single most powerful tool in your entire tax toolkit. It's all about short-term versus long-term capital gains. If you sell an asset you've held for a year or less, you pay your normal high income tax rate. But if you hold it for more than a year, the rates drop a lot. We're talking 0%, 15%, or 20%. For someone who bought crypto 15 years ago, this is absolutely massive. Patience literally pays off, and it pays off big time.
Next up is a strategy called tax loss harvesting. This is basically finding the silver lining when one of your investments is down. Here's how it works. You sell a crypto that's currently at a loss. By doing that, you realize that loss on paper. You can then use that loss to cancel out capital gains you've made somewhere else. It's a really powerful way to turn a paper loss into a tool that directly lowers your tax bill.
And this is where things get really interesting. There's a rule in the stock world called the wash sale rule. It stops you from selling a stock at a loss and then buying it right back 5 minutes later just to get the tax deduction. But guess what? As this quote from Forbes points out, because the IRS calls crypto property and not a security, that rule doesn't apply. So you can sell your crypto at a loss to harvest it for tax purposes and then buy it right back. Now be warned, this is a huge loophole and you can bet lawmakers are trying to close it. So it's a great strategy for now, but keep your ear to the ground.
Okay, let's land the plane. Section 5, your California tax plan. We're going to bring everything we've talked about into a concrete step-by-step action plan. And since we're focused on California, there's a huge catch you need to know about. The state follows the federal rules for what a capital gain is, but it doesn't give you a discount. California taxes your capital gains at your regular income tax rate, which can be over 13%. That makes all those strategies we just discussed even more critical.
First things first, let's be clear, the IRS is not messing around anymore. This question about digital assets isn't buried on page 27. It is right there, front and center on the very first page of the 1040 tax form. They want to know, and pretending you didn't see it is not a strategy. Reporting is not optional.
So what's the actual process look like? It's really a 4-step dance. First, you have to gather all your data, every transaction from every exchange and every wallet. Second, you let a good crypto tax software do the heavy lifting of calculating all your gains and losses. Third, that software will spit out a Form 8949, which is basically a giant list of every single time you sold or traded crypto. And finally, you take the totals from that form and put them on Schedule D, which gets attached to your main 1040 tax return. That's it.
Look, let's be real. If you're active in DeFi, trying to track all this manually is, well, it's basically impossible. It would be a full-time job. Thankfully, there are some amazing software tools out there that do the hard work for you. Services like Coinly or CoinLedger can plug directly into your exchange accounts and wallet addresses, suck in all the data, and make sense of it. And the best part? They generate the specific forms you need that you can then import directly into TurboTax. It's a lifesaver.
Okay, let's put this all together into your personal Mountain View action plan. Step 1. Pick one of those tax software tools and connect everything. Your Coinbase account, your wallet addresses, all of it. Step 2, and this is critical for you. For those assets you bought 15 years ago, you have to find that original purchase price, your cost basis. It's going to be a pain, but it will save you an absolute fortune. Step 3, don't just trust the software blindly. Go in and review how it categorized your tricky DeFi transactions. Step 4, export that Form 8949 and import it into TurboTax. And finally, Step 5, with a long-term, high-value, and complex portfolio like this, don't go it alone. Find a local Bay Area pro who gets crypto, like the firm mentioned here, and have them give it a final look.
So, we've gone through the rules, the strategies, and the plan. Now the real question is for you. Now that you're armed with all this knowledge, how are you going to use it? How will you think about your next DeFi move, not just for the potential gains, but for the tax implications? Because once you start doing that, you're not just investing anymore. You're strategically building wealth with a massive advantage.